Hello everyone, welcome back to a new series of videos on a new topic which is leasing. So far we have discussed different types of financial services which includes merchant banking, mutual funds, securitization, venture capital, etc. So from today onwards we will discuss another small topic which is known as leasing. In today's video, we will discuss about the introduction and classification of leasing concept. So many of you have heard about leasing in your day-to-day lives. I'm sure many of you have heard. Have you thought about the concept behind leasing or the different classifications of leasing, the type of leasing available to one particular person, etc.? So in this module, we will discuss and we will find answers to all these questions. And also, how is leasing different from rental process? Okay, so to begin with, the concept, leasing is simply a contractual agreement between two persons. Normally, one person will be known as the lessor and he will be the owner of the asset or the property, and another person who is known as lessee will be the person who takes use of this property. So this is an agreement between a lessor and a lessee. Lessor is the owner of the asset. He has the ownership of the asset, and lessee has the possession of the asset. The lessee takes the asset from the lessor, who is the owner, and he may use the asset for a specified period of time. And for using this asset for a specified period of time, the lessee needs to pay the lessor an amount or a consideration which is known as lease rentals. So the use of asset is for a fixed period of time, and till the end of this fixed period of time, lease rentals are paid by the lessee to the lessor. So I hope the concept is clear. A contractual agreement in which the owner of the asset or property, that is the lessor, grants to a firm or a person, that is a lessee, the use of the property for a specified period for an agreed sum of rent. Okay, so always remember, lessor act or lessor is the ownership of the asset lies with the lessor, and the possession of the asset lies with the lessee. Even though the lessor gives the asset to the lessee for the use, the ownership is ultimately with the lessor himself. Okay, so I hope the concept and the idea is clear. So now let's see one definition of leasing. So according to International Accounting Standard, that is IAS 17, it defines leasing as an agreement whereby the lessor conveys to the lessee in return for rent the right to use an asset for an agreed period of time. So whatever things we have discussed in the first slide is present in this definition too. So certain points to be noted are, there are two persons normally, two persons who is a lessor, we have a lessor here, then we have a lessee here, two persons. Then the second thing to be noted is there is a consideration that is known as a rent. The consideration is known as a rent. And also third thing that you should keep in mind is it is for using an asset, and the fourth thing is for an agreed period of time. So these are the main points that you need to remember while discussing about the concept of leasing. Okay, so now the contract would include certain things. First one is the basic lease period, we already discussed. So the basic lease period during which the lease is non-cancelable. So during this particular lease period of time, they cannot cancel that particular contract. This is in general terms. Okay, so when we move to the classification and the types of different leasing or the different forms of leasing, features of each leasing varies from each other. So now we are discussing about the general concept or the general features of leasing process. Okay, so second, we have the timing and payment of rental payments. That is the timing and amount of periodic rental payments during the basic lease period. So there is a time for rental payment and also a particular amount. Okay, and the third one we have at the end of this specific period. So we discussed about an agreed period of time. So at the end of this specific period, the lessee, the person who takes use of the asset from the lessee has an option either to hand over the same asset to the lessor, or at sometimes in some form of leasing he can purchase that particular asset also. Okay, so the option to renew or purchase the asset, that is also one of the main point to be remembered or to be noted while learning about leasing concepts. So any option to renew the lease or to purchase the asset at the end of basic lease period is also discussed here. Otherwise, the lessor takes the possession of the asset. And the last one, there may be different maintenance cost like repairs, cost of repairs, like taxes, insurance, other expenses, etc. The details of all these things are also included in the concept of leasing. So this is according to definition put forward by International Accounting Standard of 17. So IAS 17 put forward this definition. So IA 17 is turned into IFRS 16, which deals with leasing now, and now there is no distinction as like operating lease and financial lease. So now the concept is the right to use an asset. Okay, so no need to go more deep into that. So concentrate on our concept. So now we'll discuss about some of the characteristics which we have already discussed in the concept area and also in the definition part. So I hope you can describe the features of leasing in your own terms after understanding the concept and meaning of leasing. So it is a contract of commercial nature. Of course, it is of commercial nature. Then periodic payment of rentals are there, and this asset is used for a fixed period of time, and on the expiry of the fixed period of time or the term, the lessee should either return the asset to the owner or dispose it in a desired manner. So the desired manner may be communicated by the lessor himself. So if the lessor decides in that particular manner, the lessee should dispose it of in that way. Okay, these are the simple characteristics. So now we will discuss, or we move to the second part of this video, which is regarding the classification of leasing or lease classification. So under lease classification and from the practical point of view, lease financing can be practiced in these three forms. First is sale and lease back. Second, we have direct leasing, and third, we have leveraged leasing. So from the name itself, it indicates certain ideas. Say for example, in the case of sale and leaseback, there is a clue as to there is a sale happening and also a leasing happening. Okay, and in second category, we have a hint as to the leasing is taking place directly between some persons, and we don't know that person, so we'll learn it. And third one is leveraged leasing, which includes or which gives an idea about the involvement of debt, okay, or the involvement of borrowing. So now let's see in detail each of these classification. So first we will have a discussion on sale and lease back. So as the name suggests, we have two persons here, the lessor and the lessee. So the lessor is the leasing company. Okay. So the firm sells an asset at market price to another firm, which is the leasing company, and the leasing firm leases the asset back to the former. So let's see an example. So here we have a seller and also a buyer. So the particular seller sells his property in which he had ownership to the buyer. So this buyer will be a leasing company in this case. The buyer or the leasing company purchases that particular asset or property. And in the second stage, what happens is this leasing company or the buyer leases or gives that particular property or asset by way of leasing to the person who sold that particular asset. So first the seller had the ownership of the asset. He sells that title or the ownership to a leasing company. Then the leasing company leases this particular asset and which is taken by the seller himself. So this is a long term lease, and when the seller sells the property or the asset to the buyer, he or she gets a sale proceeds. And when the buyer leases this particular property or the asset to the former firm or the former seller, they may get a rental payment. So this is happening in sale and lease back. One firm sells its asset to a leasing company. The leasing company leases back this particular asset or property to the company who sold that particular asset to the leasing company. Okay, so I hope the idea is clear for you. The firm sells an asset at market price to another firm, that is leasing company. Then the leasing firm leases the asset back to the former. Former means the seller. Okay. Then the seller receives purchase consideration and the economic use of the asset. So when the seller sells this particular asset, he may get a consideration, and after some point of time when he takes it on lease, he may get the economic use of the asset. And this particular form of leasing is accepted or is done by a particular firm when he may find some issues with the liquidity position. So this form of leasing augments liquidity position through cash inflow. The firm or the seller firm gets a cash inflow through this method, and this is 100% tax deductible. That means the lease rentals are 100% tax deductible. The seller company is known as the lessee here, and the purchaser of the asset is known as the lessor here. And these are suitable for assets that are subjected to appreciation only, not depreciation. Okay, so that means example land. In case of land and all, this form of leasing can take place. So I hope this concept is clear for you. We have a firm A and we have a firm B. Firm B is the leasing company. A sells its property or asset to firm B, who is the leasing company, and firm B leases back this particular property or asset to firm A, for which the firm A needs to pay lease rentals. So they will get the economic use of the asset, but they need to pay the lease rentals. Okay, so I hope this type or this classification is clear for you. Now we move on to the next one, that which is known as direct leasing. So there is a direct exchange of something between some persons. Okay, let's see who all are the persons. In case of direct leasing, the firm acquires the right to use an asset from the manufacturer directly. So here the dealings are with the manufacturer directly. So the firm means the leasing company acquires the right to use an asset. Sorry, not the leasing company, the firm acquires the right to use an asset from the manufacturer directly. So actually, in real, the ownership of that particular asset lies with whom? It lies with the manufacturer. Okay, so manufacturer is the owner of that particular asset. The firm acquires or the lessee acquires the right to use that asset from the manufacturer or from the lessor. Okay, the manufacturer can also be the lessor, right? And use it for their own purpose. So in this case, the lessors can be manufacturers, finance companies, independent lease companies, etc. And here, when the vendor sells asset to the leasing company, then it is leased out to the lessee. So in this case, we have example like IBM leases computers. Then also we have Xerox Corporation leases copiers in the USA, and Modi Xerox Limited is dealing in the line of Xerox Corporation in India. So this can be quoted as an example of direct leasing. Okay, so thus in case of direct lease from the manufacturer and lessor are one and the same entity here at times. So that is regarding direct leasing, and now we have a pictorial representation of direct leasing. Okay, then we move to the third category, that is leveraged leasing. So there is a presence of debt or borrowing here. So here, apart from the lessor and the lessee, there is a third party who is involved in this process, and we can call that third party as a lender. Okay, so we have a lessor, a lessee, and a lender. So we have three persons here. So at the time of purchase of an asset, the lessor borrows a part of the cost of asset from the third person in the form of a loan. So part of the payment of cost of asset is done by the lender. So lessor, in simple terms, it means lessor takes a small amount of money as loan from the lender, and the asset purchased will be kept as the security against this particular loan. So if the lessor is not able to repay the loan, then the lender can take um, the asset from the lessor. Okay, so asset is considered as a security here. Then this particular lessor, after purchasing of this asset, leases or gives this asset in the form of leasing to another party. He is known as, or she is known as, the lessee. So the lessee pays the lessor rental payments, and these rental payments are directly paid to the lender in the form of paying back. Okay, so lender is paid off from the lease rentals by the lessee. So lender gets his money, he's happy. And if there are any surplus amount remaining after this adjustment, then the surplus amount goes to the lessor. Okay, so in this case, the lessor is entitled to depreciation allowance associated with the asset. So this is known as leveraged leasing, where there are three parties involved: lessor, lessee, and the third one is the third person, who is the lender. Okay, so that is regarding leveraged leasing. So I hope all the concepts discussed in today's video is clear for you regarding the introduction. That means introduction of the concept. I hope the idea is clear to you, and also the classification regarding sale and leaseback. Then we have direct leasing, and third one we discussed about leveraged leasing. So among this, um, sale and leaseback and this last portion, that is the leveraged leasing, will be a bit confusing for you, but it's okay. Go through the videos again and try to understand all the concepts discussed in this video. So we'll meet another day with another new video. So for now, thank you.